Ontario's housing market has long been both admired and feared for its soaring prices. But now, the warning signs are impossible to ignore. Homes are sitting longer, inventories are swelling, and price growth has flatlined across much of the province. Major banks and housing analysts expect Ontario to face some of Canada's steepest declines through late 2025 and 2026, as high debt, rising rates, and oversupply take their toll. In this video, we're breaking down 10 Ontario markets showing the clearest signs of a housing correction. We'll explore key trends in prices, sales, and listings, examine local economies, and highlight both the risks and potential bright spots. By the end, you'll know which areas are most at risk, and what this shifting market means for you as a buyer, seller, or investor. Why Ontario is uniquely vulnerable in 2025. Despite recent rate cuts, Ontario remains Canada's least affordable housing market. Prices from Toronto to Kingston still outpace incomes, and analysts at CMHC and RBC predict the province will see the sharpest price drops through 2026 due to oversupply and fading demand. By mid-2025, Ontario listings hit 78,600, nearly 50% above the 10-year average, signaling a clear shift to a buyer's market. Condo vacancies are also climbing, especially in the GTA, where thousands of pre-construction units remain unsold. Meanwhile, household debt is at record highs. Even with the Bank of Canada's rate cuts, mortgage payments have soared, and many owners face renewals at double their previous costs. Job losses in manufacturing hubs like Hamilton could quickly weaken buyer confidence. Adding to the pressure, slower immigration means fewer renters and first-time buyers, while falling numbers of international students and temporary workers are cooling demand in Toronto and Ottawa's condo sectors. Together, these forces, high debt, excess supply, and slowing population growth, make Ontario's market uniquely fragile in 2025. The province's housing correction is already underway, and some cities are feeling it more than others. 1. Toronto, Ontario. Toronto remains the epicenter of Ontario's housing correction. As of August 2025, the average home price in the city sits at around $969,700, down 5.2% year-over-year, while condo prices have fallen roughly 7% to $571,500. Even rental rates, once red-hot, are cooling. Toronto rents have dropped by about 3% year-over-year. Sales activity is modest, and active listings have surged, with thousands of unsold condo units now sitting vacant across downtown. Economically, Toronto's foundation is still strong. It remains Canada's financial and tech hub, supported by major employers, universities, and institutions. But rising living costs and Ontario's broader manufacturing slowdown are putting real pressure on households. Net migration into the city remains positive, yet slower than in past years, and analysts at RBC warn that federal immigration cuts could sharply reduce demand in the condo and rental sectors. The warning signs are hard to miss. Toronto's price-to-income ratio is among the highest in the nation, and the market has flipped decisively from a seller's to a buyer's landscape. Months of inventory have soared, and sales-to-listings ratios below 40% confirm that buyers now hold the upper hand. The city's condo glut is particularly concerning. Resale condo inventory is at generational highs, while many pre-construction towers remain 70 to 80% unsold. Even affluent buyers are stepping back, as high mortgage qualification thresholds limit how much they can borrow. Those most at risk are speculative condo investors and heavily leveraged homeowners. With rents falling and vacancies rising, many landlords are struggling to cover mortgage payments. First-time buyers with minimal down payments face similar danger if prices dip further or variable rates climb again. Still, Toronto isn't on the verge of collapse. Its strong job market, steady wage growth, and continued, if slower, immigration provide a solid demand base. Mortgage rates are beginning to ease slightly, offering some relief. In short, Toronto is undergoing a prolonged correction rather than a full-blown crash, a necessary cooling after years of unsustainable highs. 2. Mississauga, Ontario. Mississauga is feeling the full impact of Ontario's housing slowdown. By mid-2025, The city's average home price has dropped to $1,019,578, down 7.6% year-over-year, with sales volume sluggish and supply building rapidly. The sales to new listings ratio sits below 30%, a level that firmly defines a buyer's market, far from the 60% threshold typically considered balanced. Much of the rapid price appreciation seen between 2020 and 2022 has already been erased. As a key suburb within the Greater Toronto Area, Mississauga remains an important business hub, home to corporate offices in finance, logistics, and pharmaceuticals, as well as a large commuter population. Its local economy is stronger than many smaller Ontario markets, but remains tightly linked to Toronto's performance. Job growth has held steady, yet rising housing costs continue to squeeze household budgets. The return-to-office trend could eventually strengthen local demand, as more residents prefer to live closer to work, though for now, interest rates remain the dominant market force. Several warning signs point to continued vulnerability. Mississauga's price-to-income ratio is severely stretched, with average household earnings far below the city's million-dollar home prices. Developers built aggressively from 2020 to 2024, flooding the market with new condos and townhomes that are now struggling to sell. Vacancy rates are rising, many listings are being repriced downward, and foreign investors are quietly exiting. The large rental sector is also under strain, as new supply continues to outpace tenant demand. Those most at risk include over-leveraged families and investors who bought during the boom. Many homeowners who secured 5-year fixed mortgages at around 2% in 2021 are nearing renewal at much higher rates, threatening to upend monthly budgets. Pre-construction buyers, especially in condo projects, face the risk of negative equity if prices slide further before their units close. Despite these challenges, Mississauga retains several stabilizing factors. Its proximity to Toronto, major transit expansions, including the LRT and airport improvements, and relatively spacious suburban layout keep it attractive to buyers priced out of the downtown core. While the correction may continue through 2025, the city's strong employment base and infrastructure growth should help flatten the decline once affordability begins to improve. 3. Brampton, Ontario. Brampton has shifted sharply into buyer territory as its once booming housing market cools. By mid-2025, the average home price stands at $954,523, down 5.5% year-over-year, with sales declining and listings up roughly 15% compared to the previous year. The sales-to-listings ratio of about 27% confirms that Brampton is now a clear buyer's market. Once fueled by rapid population growth, affordable land, and pandemic-era demand, the city's housing momentum has slowed dramatically. Brampton's economy, built on manufacturing, logistics, and food processing, continues to provide solid employment, but many local workers earn below the GTA income average, making homeownership increasingly difficult. The city's young, multicultural population remains a strength, yet rising living costs are beginning to strain household finances, especially for families who bought at peak prices. The warning signs are evident. Housing values have become severely disconnected from local incomes, leaving many residents financially stretched. A wave of new construction from the 2020 to 2023 period has added to supply, with unsold condos and townhomes stacking up. During the pandemic, Brampton attracted speculative investors hoping to flip homes for quick gains, but that pool of demand has now dried up. The market's correction is exposing these overextended buyers, many of whom are struggling with rising mortgage costs and slowing rent growth. Those most at risk include first-time homeowners and recent buyers who relied on long amortization periods or minimal down payments. As mortgage rates have risen, monthly obligations have climbed sharply, pushing some households toward financial stress. Condo investors face a similar squeeze as rental demand softens, making it harder to cover carrying costs. Still, Brampton retains several stabilizing factors. It remains more affordable than neighboring Mississauga or Toronto and continues to attract families seeking larger homes and suburban space. Infrastructure upgrades, such as new schools, highway links, and ongoing transit expansion projects, support long-term appeal. With a youthful demographic base and a steady inflow of new residents, Brampton's fundamentals aren't collapsing. But without stronger job growth or further rate relief, prices are likely to drift lower before stabilizing. 4. Vaughan, Richmond Hill, York Region, Ontario. By mid-2025, Vaughan and Richmond Hill have emerged as two of Ontario's hardest-hit housing markets, with average prices dropping roughly 12.9% and 11.9% year-over-year. Once considered symbols of wealth and suburban comfort, both cities saw rapid expansion during the pandemic housing boom, fueled by luxury home building, speculative condo projects, and strong demand from new immigrants and investors. Now that demand has cooled sharply, listing inventories have surged, and sales to new listings ratios sit in the high 20% range, indicating a firm shift toward a buyer's market. In Vaughan, several large condo projects launched at peak prices remain partially unsold, and Richmond Hill's upscale neighborhoods are seeing noticeable price cuts even in once coveted areas. Those most exposed are high-end buyers who upgraded near the market's peak, often after selling in 2021 and buying again in 2024, and condo investors who relied on low rates and quick appreciation. With weaker rental yields and higher carrying costs, many are now under pressure to sell or absorb losses. Still, Vaughan and Richmond Hill retain strong fundamentals: high household incomes, reputable schools, and access to Toronto's transit network. These strengths will help cushion a complete collapse, but experts predict that it may take several years for prices here to stabilize or rebound meaningfully. 5. Hamilton, Ontario. As of August 2025, Hamilton's housing market shows a mild but noticeable cooling trend. The average home price stands at about $776,000, down 2.3% year-over-year, with detached homes averaging roughly $842,000 and condos around $466,000. Inventory has climbed by about 18% compared to last year, though sales activity has inched up slightly, signaling that demand hasn't completely disappeared, but buyers now hold more leverage. Hamilton's economy remains diverse, anchored by steel and aluminum manufacturing, major institutions like Hamilton Health Sciences and McMaster University, and a modestly expanding tech sector. Still, unemployment sits higher than in the GTA, and manufacturing continues to face uncertainty due to global trade tensions and structural shifts in the auto and steel industries. The city has already seen a correction from its pandemic highs, with detached homes giving back much of their earlier gains. Dozens of new condo and subdivision projects launched during the boom are now struggling with high vacancies, and job cuts in industrial sectors are weighing on confidence. Those most exposed include condo investors who took on excessive leverage and families that stretch their budgets expecting population growth to drive prices ever higher. Yet Hamilton's lower entry prices and growing population, fueled partly by GTA outmigrants, provide a stabilizing force. The city's relatively strong employment base, combined with ongoing demand for quality housing in established neighborhoods, makes a severe crash unlikely. Instead, Hamilton's market is expected to experience a slow adjustment or plateau rather than a dramatic collapse. 6. Niagara Region, Ontario. As of August of 2025, Niagara's housing market is showing signs of strain beneath a deceptively stable surface. The average benchmark price for a single-family home sits around $610,000, flat month-over-month. But this masks deeper market weakness. Sales in August plunged 17% from July to just over 530 transactions, while new listings continue to flood in. Homes are now taking an average of 48 days to sell, up 23% month-over-month, and the sales-to-new listings ratio has fallen to 38%. Clearly marking a shift toward a buyer's market. The region's economy, built on tourism, light manufacturing, and a rising retiree base, faces unique vulnerabilities. With average incomes well below GTA levels and many residents reliant on fixed or limited earnings, affordability pressures are mounting even in a market long considered inexpensive by Ontario standards. Niagara's red flags are growing. An oversupply of listings, soft demand, and an economy that depends heavily on tourism and discretionary spending. Any downturn in travel or consumer confidence could further weaken local housing demand. The construction surge of recent years has left behind a glut of new condos and subdivisions, many struggling to find buyers. Investors who bought vacation or rental properties at peak prices are now the most at risk, especially as rising costs erode profitability and equity. Still, Niagara's relative affordability and lifestyle appeal provide some cushioning. Retirees, remote workers, and families seeking value continue to view the area as an attractive alternative to the GTA. While prices may edge lower in the short term, the market is more likely to experience a moderate correction than a full-blown collapse, a gentle adjustment reflecting oversupply rather than a total loss of confidence. 7. Durham Region, Oshawa Area, Ontario. Between January and July 2025, the Durham region's housing market, which includes Oshawa, Whitby, Ajax, and Pickering, has clearly shifted into correction territory. The average home price sits around $900,000, down 3.7% year-over-year, while sales have fallen roughly 11% and listings climbed 14%. Analysts project prices could decline another 5% by year's end, signaling continued cooling. Durham's economy is diverse, anchored by auto manufacturing in Oshawa, education through Ontario Tech University, and suburban financial and service sector jobs. While the region's incomes are moderate and generally higher than Niagara's, they still trail much of the GTA. Despite new auto investments and modest job growth, economic uncertainty and high borrowing costs have dampened homebuyer confidence. Durham's housing market has clearly transitioned into a buyer's market, characterized by longer selling times, rising inventory, and growing price reductions. Many families who bought during the pandemic's frenzy, banking on endless spillover demand from Toronto, are now facing the reality of stagnant or falling values. The most at-risk homeowners include first-time and move-up buyers who stretch their finances with long amortization periods or high-ratio mortgages, as well as sellers who need to offload their homes to purchase another. Yet, despite these pressures, Durham retains strong fundamentals. Its family-friendly appeal, solid infrastructure, and relatively affordable detached homes continue to attract buyers priced out of York or Peel. Certain neighborhoods, especially newer developments in Whitby, remain resilient. Moreover, stable employment across education, healthcare, and public service sectors provides a buffer. As a result, Durham's housing market is more likely to see a slow, controlled descent rather than a steep crash, a gradual correction following years of overheated growth. 8. Kitchener-Waterloo, Ontario. Between January and July 2025, the Kitchener-Waterloo housing market has clearly cooled after years of rapid growth. The average home price now sits around $750,000, down 2.9% year-over-year. Sales have dropped by about 11%, while new listings have risen 8%, giving buyers far more options than before, though the market remains less oversupplied than the Greater Toronto Area. Once considered Ontario's tech-fueled powerhouse, Kitchener-Waterloo's economy remains diverse, supported by its universities, Waterloo and Wilfrid, Laurier, tech giants like Google and Shopify, as well as manufacturing and insurance sectors. However, the recent wave of global tech layoffs in 2023 to 2024 has cooled the region's previously red-hot demand for housing, as fewer new workers enter the market and some job holders face uncertainty about their positions. The signs of a correction are unmistakable. Price growth has stalled, bidding wars are disappearing, and properties are sitting longer on the market. Condos and detached homes alike are seeing softer demand, with many investment-oriented projects struggling to attract buyers or tenants. Vacancy rates have ticked up, particularly in downtown Kitchener's newer condo buildings. Those most exposed to risk include tech workers who bought at peak prices during the boom, especially younger employees who entered the market on the back of early career salaries that are now stagnant. Similarly, long-distance commuters from Toronto who speculated that KW prices would continue to climb could face negative equity if forced to sell. Still, the region's fundamentals remain strong. With its high-paying tech and education jobs, strong immigration appeal, and steady rental demand from students, Kitchener-Waterloo continues to enjoy a solid economic base. Demand from families, professionals, and downsizers remains resilient, and many buyers who locked in mortgages before rate hikes are still financially stable. Overall, while KW is experiencing a healthy correction after years of unsustainable gains, its market appears set for a gradual cooling rather than a dramatic crash. 9. Windsor, Ontario. Between January and July 2025, Windsor's housing market has begun to cool after several years of impressive growth. The average home price stands at roughly $575,000, essentially flat year over year, with a slight uptick of 0.2%. However, behind that stability lies a clear softening trend. Sales have slowed, inventory has climbed by about 13% compared to 2024, and analysts expect prices to decline by 3 to 5% by the end of the year. Windsor's economy remains heavily tied to auto manufacturing, particularly the Ford plant, along with cross-border trade and logistics linked to Detroit. While unemployment is moderate, average household incomes are among the lowest of Ontario's major housing markets. This gap between earnings and home prices, after the pandemic surge, is now becoming more visible, particularly as affordability pressures mount and rate-sensitive buyers pull back. Warning signs of a cooling market are evident. The sales-to-listings ratio has slipped into the high 30s, marking a clear shift toward buyer advantage. Even though Windsor remains one of Ontario's most affordable cities, homes are still expensive relative to local wages, especially for first-time buyers. Rental vacancy rates have started to rise, and sellers in nearby suburbs like LaSalle and Amherstburg have been cutting prices to move properties. The biggest risks lie with speculative investors, particularly those who bought into short-term rental properties expecting strong Airbnb returns. As demand softens, many of these owners may face underperforming assets and shrinking margins. First-time homeowners who entered the market with little financial cushion could also feel pressure if borrowing costs rise or their fixed-rate mortgages come up for renewal. Yet, Windsor still enjoys important stabilizing factors. It's young, growing, and relatively affordable compared to Toronto or Mississauga. The city's proximity to the U.S. border and steady industrial base provide an anchor of economic stability, while some rental demand from Detroit commuters continues to support the market. Local economists largely expect Windsor's correction to remain mild, more of an adjustment than a collapse. The city's housing boom from 2017 to 2021 is clearly unwinding, but it's doing so in a controlled, sustainable way rather than a full-blown crash. 10. Kingston, Ontario. As of February 2025, Kingston's housing market has clearly cooled from its pandemic-era highs. The average home price sits around $606,000, down 7% year over year, with sales volumes falling about 20% and new listings up 14%. Buyers now have abundant choices, and properties are taking longer to sell as days on market continue to climb. Kingston's economy remains anchored by stable employers such as Queen's University, federal correctional facilities, and the Naval Dockyard, with tourism and the public sector rounding out its job base. These sectors provide consistent employment, but overall incomes remain moderate. The city benefited enormously from pandemic migration trends when people fled major cities for smaller, scenic communities, spurring a wave of new development that is now exceeding current demand. The warning signs are unmistakable. Kingston's housing boom between 2022 and 2024 appears to have outpaced its economic fundamentals. By early 2025, median prices had already fallen about 20% from their peak, and higher-end homes are now facing the sharpest declines. A growing pipeline of new condos and suburban subdivisions has created excess supply, with more properties hitting the market than buyers ready to absorb them. If local institutions like Queen's University moderate enrollment growth, or if retiree demand cools, Kingston's lower-end housing segment could face additional price pressure. The most vulnerable homeowners are those who bought at peak valuations with limited financial flexibility, such as first-time buyers who stretch their budgets or investors banking on easy rental demand. Many rental units that were once considered surefire investments are now sitting empty or underpriced as the market softens. Even so, Kingston's underlying stability offers a buffer against a major crash. The city's public sector-heavy economy shields many households from severe economic volatility, and its strong quality of life continues to attract downsizers and professionals seeking affordability. Certain surrounding areas, like Loyalist Township, have even recorded modest price increases in 2025, suggesting that Kingston's correction may be a healthy rebalancing rather than a collapse. While prices are clearly trending down, Kingston's market still stands on relatively solid ground compared to Ontario's more speculative urban centers. Ontario's housing markets have reached a turning point. What was once a relentless upward spiral is now flattening out and, in many cases, reversing. Affordability concerns have finally tipped the scales. For homebuyers and homeowners alike, this means risk is higher than in recent years, and decisions should be more deliberate than ever. Markets like Toronto, Mississauga, Brampton, and parts of southwestern Ontario are particularly at risk right now. However, it's not time for fear. It's a time for prudence. Use this slowdown to make smart choices. Buy at fair value if you can, price competitively if you sell, and always keep a buffer in case things get worse. Please like this video and subscribe for more housing market updates. Share your thoughts or questions in the comments below. We'd love to hear about your experience in the Ontario market. Thanks for watching. Stay informed and take care in these uncertain times.